Hey everyone, welcome to High School Dropouts Advice. Today we are talking about the best dividend stocks. Some of my viewers and subscribers wanted to know more about dividend stocks, and here is the video for you guys. For us to determine which is the best dividend stock, let me quickly explain what dividend stocks are and what attention you have to pay for a dividend stock so you don't get misled. Dividend stocks are stocks that pay you a little part of their profit based on the amount of stocks you are holding. For example, if you own 10 Apple stocks, they will pay you 82 cents per stock per year. So you will receive 10 times 82 cents, which is $1.20. Not a lot, because they only give you 0.68% per year. The payout of the dividends would be in most cases in 4 quarters, so you get your dividends every 3 months. You might think it's better to look for the highest dividend paying stock now, since Apple is giving you so little. Let me show you another example. Iron Mountain, which trades under IRM, pays a 6.74% dividend, which is really great, right? So for every $100 invested, you get $6.74 in dividends. Let us compare this with Apple to understand what is going on and what would have been better for you. Let's assume we bought these 2 shares for $1,000. In January 2011, Apple was trading at $12 per share and you would have purchased 83 of them. Iron Mountain was at $24.6 and with your $1,000 you would have bought 40 of them. After around 10 years, Apple shares price increased nearly 10 times, pushing your investment of around $1,000 to $10,000. Over the 10 years, it pays you around $74.80 in dividends. The math is 1,000 invested multiplied by 0.68% multiplied by 11 years. I have a little simplified this because the dividends get a slight adjustment each year, but it will still be able to show you the point I want you to understand. The investment in Iron Mountain made around 50% more. So your investment of $1,000 becomes $1,500. Let's check out the dividends. $1,000 invested multiplied by 6.74%, which is 67.40 cents. Multiplied by 11 years, we will have $741.40. So in total, Iron Mountain return was $2,241.40 and Apple was $10,074.80. Let me explain to you the problem with dividend stocks. Dividends are usually used by companies that do not need that extra profit to expand their business. This is why they use the dividend to give it back to the investors. If you look closer, every growth company like Tesla, QuantumScape, NIO, EHang, Palantir and Co. won't give a dividend. First, they are not profitable yet, and second, if they are profitable, they need the money to grow. So, does it mean that dividend stocks are bad? No, dividends are by no means bad, but our focus in picking dividend stocks should not be based just on the percentage they give you, but also on their fundamentals. Now that you understand this part, let us move on to find good dividend stocks. Let me share you Simon Property Group. Simon Property Group is a real estate investment trust owning the biggest mall in the US. Many Class A and B malls are owned by SPG, and they have acquired some of their tenants like JCPenney, Forever 21 and Aeropostale. They are also creating a SPAC now to have another division focusing on buying bankrupt retail chains. So Simon Property Group is not just surviving the pandemic, but also aggressively buy out those bankrupted companies. When it goes well, Simon Property Group will do insanely well with this move. Me personally, I know that retail and malls will not get obsolete from today to tomorrow. Simon Property just has the best malls in the country, and their malls were growing when others were declining. So if you bet on malls, SPG would be the best option. They also know that retail will decline, and they are diversifying their portfolio now and recreating malls as we know. So the future malls will have parks, restaurants, offices, hotels, and doctors' offices, and much more. So all point of interest will be more condensed in one area. So this makes me more confident in their management and their outlook in the future. At this point, please subscribe to my channel, share and like the video to help me and the YouTube algorithm. Let us check the fundamentals of our SPG stock. We have 4.53% in dividends, which is a good paying dividend. On top of that, the stock is trading lower than pre-pandemic, which was at around $150 per stock. I bought the stock in the high 60s because the stock has so much upside and the dividends were only a bonus for me. In short, this can be an excellent dividend paying stock for your portfolio if you believe that malls will stay in the next 10 to 20 years. In the communication sector, we also have good paying dividend stocks like AT&T, Verizon and Vodafone. All pay great dividends, and with the new 5G technology coming, there is more growth expected in this sector. AT&T is having a 6.86% dividend, Vodafone 5.7% and Verizon 4.31%. That being said, I think Vodafone will do very well in Europe with its recent development. Vodafone has created a company named Vantage, which owns 68,000 base stations. The 5G infrastructure will be better than competitors and they are better prepared. Overall, Vodafone is a defensive stock in Europe with strong fundamentals, and there is an upside for the stock price plus a good paying dividend each year. The same scenario also applies to Verizon in the US. Before I tell you more facts about Verizon, you might ask why 5G is so important. Your YouTube videos are fast enough and you can see me in a good quality. Let me tell you that 5G will open many new possibilities. One example is that the high-speed internet connection can connect a rural hospital with an operation robot. A doctor from another city or country can connect to that robot to operate on a patient without any delay. The delay with the 4G network would have been not safe for doing operations. The commands you send would come too late and the pictures you see was half a second ago or even more. The current cheap evaluation of Verizon and the high yield, which the dividend is also known, is better than any bond on the market. So a safe stock with an upside potential and good yield is quite a good investment. I think with this video I could show you that a high yield or high dividend is not everything. The outlook and potential for an upside for the stock and company are also very important. In my opinion, dividends should not be the primary motivation to invest. You can use rising stock prices to sell some of your stock, which acts like dividends. Usually, dividends are like a brake which prevents the company from growing. The dividends are already calculated in the stock prices. This means the stock would have traded higher when there were without the dividends. So please don't give dividends so much value for choosing the stock. Anyways, for legal reasons, I have to say I'm not a financial advisor. I'm just a guy on YouTube. Do your own due diligence and remember that your money is your responsibility. If you like my video, please subscribe to my channel where I update you about exciting stock news and investment opportunities. Thank you so much and see you hopefully in the next video. Thank you, bye!